Hello, how is everyone doing today? My name is Eric Inothia from Catch Connect. Today I want to speak about something interesting, something I love, and also speak about Catch Connect. So what are we doing at Catch Connect? Catch Connect is a startup within the credit and lending space. We are here to help more SMEs acquire financing to boost their businesses, grow their businesses, and overall contribute better to our economy. Why SMEs? If you look at statistics, according to the Kenya National Bureau of Statistics, MSMEs, that is the micro, small, and medium enterprises, they take up more than 90% of the businesses that we have here in Kenya, and they employ more than 80% of all the active working population, and they contribute approximately more than 40% of our GDP. This is a very crucial industry or sector of the economy because it basically holds, it is the heart of our economy. In as much as we have big corporations that employ hundreds, thousands of people, you realize that it is these small businesses, it is that shop by the roadside, it is that kibanda, it is that smoky guy. Those are the little, those are the micro businesses. We also have the small, that is those a little bit larger businesses. That is businesses. We have small processing plants, manufacturing plants. We also have quite larger enterprises that fall within the medium category. These are companies that employ well above 50 people. All these combined, they're the ones that encompass the MSME sector. So Catch Connect is coming to the space to provide credit for this. But within the existing credit space, because they say that when you go to Rome, you have to do as the Romans do. So very new in this credit space. I have been in finance, more so within the investment side and fund management for the last about 5 years. But now, considering that Kenya is majorly a credit market, and I felt it's a space that is fundamental into what determines the growth of an economy. Why so? You find that for businesses to grow, for businesses to boom, for businesses to do better, to thrive, to employ more people sustainably, they need access to financing. You find that some businesses operate by selling their products and then waiting some 30 to 45 to 90 days before their customers pay them back. So you find that for this deficit that these businesses incur as they wait for their customers to pay, this deficit needs to be financed. That is where things like credit come in. You also find that a business is making good revenue every other month, but it cannot sustainably finance itself to expand. So credit comes in to help in business expansion, business growth, and even just to provide working capital. That is as businesses wait for their receivables, they can sustainably pay their employees, finance their business expenses, etc. But I've been looking around. The last month, we began Catch Connect about 2 months ago. I have a small team that we are actually building this startup with, and when we began ideating this and started throwing ideas to each other, I decided to first get to understand how our market really is. And yes, I understand there are nuances of our market that I'm yet to grasp, but just the basic things first. I was looking at what is the typical lending rate at current, that is within our banks, within our microfinance institutions, and even the digital lenders that we have and other lending entities that we have. And you find that, first of all, let me talk about the interest rate. The whole of 2024, our interest rate that banks and microfinance institutions offered credit under was well above 15% if we look at all players. And how is the interest rate is determined first of all by the central bank. The central bank regulates the rate at which our banks offer credit with. And if let's say the central bank rate is 10%, of which at current it is 10%, which was adjusted just a few weeks ago. So at 10%, that is the rate at which banks get money or maybe borrow money from the central bank. At 10%, you find that banks now add their premium, they call it the premium K, that is for them to be able to finance their operations, you know, and it's called the cost of credit. And that was a standard. Now, let's look at a 15%, let's say, final rate by one bank. So central bank does 10%, a certain bank does 15%. So I found that this rate fluctuates from one bank to another. So you find that certain banks, this rate did go as high as 19%, and in some cases even as high as 22%. Yes, it's a free market, and different players, different conditions, different environments. That's why we have the different interest rates. If we look at the microfinance institutions, their interest rates typically begin at 20%, with some going as high as 25%, and in very rare cases, maybe 30-35%. As for digital lenders, it's a space I do not even wish to get into, because for them they exhibit very, some of them exhibit very cannibalistic, I would call them very cannibalistic practices. Because why should you offer credit to someone who deserves it, someone who needs it for their business growth, for their operations, and offer it to them out of desperation at annualized rates of 150%, 200%, 300%, some going as high as, I don't know. Because if you offer credit to someone at, let's say, if you're a digital lender, you offer credit to someone at, let's say, 7%, let's say every 2 weeks. If you do that monthly, that's 14%. If you do it annually, we are talking about 160 plus %. That is not justifiable. So we find that because we are still a small economy as opposed to very developed economies, that is the likes of China, the US markets, because first of all, just looking at the base rate of the comparison of the base interest rate, you find that when in 2024 our interest rate was at 13%, the central bank rate was 13%. In the US, it was around 5%. In China, it was around 3%. So, yes, I understand that we are not yet there. Our economy is still young. we need to have larger breathing rooms for our capital, our available capital. But you realize that the larger the breathing room we create for our capital, the more economy suffers through ripple effects. In what context? So this high cost of credit, if the borrowers need to incur high interest rates for them to access just basic capital, and you realize that capital, or rather financing, credit, is almost a necessity for businesses, and it is not a luxury. It is not that someone comes to take credit, as a way of luxury. Sometimes businesses just need to finance their working capital needs as they wait for their receivables to mature. Sometimes businesses need to grow. Their customers, they have higher demand more than they can satisfy. They need capital to expand and sustain that demand. So capital financing is almost a very basic necessity for businesses. So if borrowers need to incur high interest rates, it means that this needs to be trickled down to the final consumer. So find that the final consumer is going to pay more for the same goods and services they access, simply because the borrower needs to account for the high borrowing cost. They need to account for the rising cost of living. And remember, all this is happening in an economy that is still grappling with a lot of unemployment, still grappling with a lot of corruption that is eroding much of the available resources within our economy to help our own businesses and economy thrive. And at the end of the day, it is a system, it is a very flawed system, it is a very flawed economy where it becomes a man-to-man society. The bank, the microfinance, the digital lender needs to put a high interest for them to survive. The business owner needs to increase the prices of their goods and services for them to basically survive. The final consumer is either unemployed, underemployed, that is, if they're employed and they take a lower pay than they are supposed to, they are underemployed. Or even for those who are doing well, they are dealing with a high number of dependents. Because at the end of the day, people need to eat, people need to sleep, people just need to afford their basic human needs. And if they are not sufficient within our economy, you find that it trickles down to those who are able need to, are the ones who have to, sustain those who are not. So picture all that. And well, yes, it can be justified. So this conversation was about first the interest rate. So while this can be justified, I believe that there are solutions that can be developed within our economy for our ecosystems that will get to solve that which we are dealing with, in the sense that you realize that for some businesses come with, maybe, for example, a customer. I've gotten to interact with a few clients over the last month, just potential leads of people who would be interested to take credit, who are actually looking for credit, as well as people who already have access to credit with other players, just to get to understand the kind of things they are dealing with. So you realize that that just somehow, somewhere, the system is flawed. And some businesses come looking for credit, but essentially, it is not credit that they need. it is they need to improve their operations, they need to improve their management, they need to improve how they handle their finances, they need to market their businesses more for them just to do well. They don't need credit. But when people access problems, what do? People, come seeking money. We technically, it is the analogy of throwing money to problem or problems that don't need money, problems that need to be solved through other methods, through other ways. So if you simply throw money to that problem, because if you look at on the lender's perspective, there are targets to be met. There's amounts, there's money to be disbursed every other month. There are KPIs that sales credit officers need to meet, without really understanding the different nuances of this very diverse MSME sector. So our involvement at Catch Connect is that we want to get into the space to understand what happens. We want to understand the different problems that our MSMEs incur when they are actually looking for credit, finding solutions for them that beyond the credit, is there something else that this business needs? Yes, you will get the money. Yes, you come looking for money, you will get the money. But beyond that money, is there something else that you need? For you to sustainably, maintain your business, grow your business, what are the measures? What are the different practices, measures that you need to put in place? So, our call to action is that we are coming to connect lenders, MSMEs, that is the borrowers, connecting this ecosystem. It has already been running, and essentially what we are coming to do is that we are not coming to reinvent any wheel further. We are only coming to find how we can, change, have the paradigm shift in some of the practices that we've been seeing happen within the space. For example, there is the collateral-based lending. You realize that in most lenders, there is the basic rule of thumb that for any borrower, or rather for most of their loan products, that they have to be backed by some collateral. But what logic does it, what logic is there for you to finance a certain borrower just because they have the collateral that you want as the lender, but this business, or rather this borrower, cannot sustain, their day-to-day income, their monthly income cannot sustain good repayments, maybe repayments on time, or even just repayments. That you need to understand, that we need to understand the different borrowers, the different capabilities, that it is their monthly income that will lead, it is them having a stable monthly income as a business or as a borrower that will enable them to repay back the loan. So, because if you look at even just the recent statistics of NPLs, digital lenders, despite their very high interest rates, they've been incurring very high NPLs lately. Microfinance institutions, their NPLs are going up. Yes, we might blame, the easy solution is to blame. It has been a tough economy. 2024 was a tough year. There was, there are floods that came about. There was the protests towards the middle of the year. There was just a high, a difficult macro environment. Yes, those are the easy thing. The easy solution is to blame these external factors. But then the more difficult solution is to really understand the nuances in how lending has been taking place. That is the actual lending that is there sustainable? Because if I am a borrower, I come to a bank or I come to a microfinance or even I download a digital loan app and I borrow a loan and I am charged 30% interest, and I cannot sustainably, even my own business, my own income cannot sustain that debt. What does it mean? It means that I will end up defaulting. If then, still another thing is the willingness, because if you look at what defines how what really makes people even pay back debts is the willingness. If is someone willing to, by the time someone is taking a loan, first of all, there is the issue of cooking books. People cook documents. Businesses, companies cook documents when they're applying for loans, only to end up defaulting because in the first place, the original intention of the loan was not clear and was not truthful in the first place. So all these different things need to be addressed, and it will take very difficult work and a lot of work, and perhaps for a very long period of time for this whole ecosystem to work. But that work needs to be done. We cannot have NPLs going as high as 40% for microfinance institutions. We cannot have them going as high as 20% for banks. We cannot have them going even way higher for other lenders, because it is a system. It is an ecosystem that has been built on mistrust, bad governance, and just bad practices. But all this needs to be taken care of. Don't crucify me yet if you've been a lender or you've been an expert within the space for years. But I'm certain that better days are coming. We're going to have a more inclusive ecosystem and something that is considerate for everyone involved, for the borrowers, for the lenders, and for all the different stakeholders involved.